Hey, welcome everybody. Welcome. Good morning. Good morning, good afternoon, good evening, depending on wherever you are logged in from. So, guys, we will be starting very soon. If you guys can just let us know where you're logging in from. I know there are quite a few from Singapore, but let's see where you guys are from. Okay, we have a Hong Kong. Uh, wow, Singapore, Malaysia. So, Thailand. Awesome. Awesome. So Gautam, is your book available in all these markets on Amazon?
It's available on all the Amazon websites globally. And for people in countries with no Amazon websites, they can get a copy from bookdepository.com.
Ah, okay. Oh, that's fantastic. Okay, so we have we have people from all over India, Singapore. Fantastic. So you can see Gautam, you have quite a lot of fans in Asia. All right. Okay, so okay, a very warm welcome to everybody to the Knowledge Series panel discussion by MoneyWiseSmart. I have great pleasure in introducing our guest, Mr. Gautam Bed. Gautam is the author of the international bestseller, The Joys of Compounding, and a portfolio manager based in US. After having read his book multiple times, I have come to the conclusion that if compounding was a religion, Gautam's book would be equivalent to the Bible. We are eagerly looking forward to hear about his fascinating journey. And our panelists, we have Serjing Chong. He served in the Motley Fool as a writer as well as co-leader of the investing team, both as part of MF as well as his family office. He has beaten the benchmark index by a very wide margin over the last decade. Now, he recently co-founded the Compounder Fund, a long-term focused equities fund, and he's also the author of one of my most favorite blogs, The Good Investors. Amazing investing insights, a discourse in financial history. Serging, if you can please share the link of your blog in the chat for our viewers.
Yeah,
So
sure.
while Serging is doing that, now in Joys of Compounding, Gautam quoted Upton Sinclair. It goes like this. It's difficult to get a man to understand something when his salary depends on his not understanding it. You cannot really understand how the world truly works unless you have financial independence. Our next panelist, Kelvin Sito, achieved his financial independence at the early age of 24. He's the founder of Growth Investing Mastery and specializes in identifying high quality small mid cap companies with huge growth potential. Kelvin, if you can also share the link of where our viewers can find you.
Sure.
And lastly, my name is Rupam Deb. I'm the moderator for this session. I'm the co-founder of MoneyWiseSmart. We are an investment education and research company. Now, we will start with a power-packed presentation by Gautam, followed by a panel discussion. So please send us all your questions for the panelists through the chat window. And without further ado, I pass the mic to Gautam. Gautam, take it away.
Thank you for the kind introduction, Rupam. It is a pleasure to be here. Please note that the views expressed in this presentation reflect my personal analysis and opinion and not that of my employer firm. The stocks discussed are for educational purposes only and not to be construed as investment advice. Please do your due diligence and consult your advisor before acting on this analysis. Today, I will be covering a range of topics, including compounding, passion, wealth creation through equities, how to navigate, and value investing as a life discipline. Albert Einstein had defined compound interest as the eighth wonder of the world. He who understands it earns it, and he who does not understand it pays it. This is how compounding looks like in real life. Self improvement is the ultimate form of investing in oneself. It requires devoting time, money, attention, and hard effort now for a payoff later, sometimes in the far distant future. A lot of people are unwilling to make this trade off because they crave instant gratification and desire instant results. These short term costs, when applied the right way along an axis of time, offer an exponential payoff when applied over a long life. That is how you get to experience the J curve as shown in this particular graph. But before that, most people will have to undergo and experience what is known as the valley of disappointment. Because during the initial years, in spite of putting in all the hard work and effort, they have little tangible or concrete results to show for it. People who have heard my previous podcasts or read my previous interviews know how when I came to America 6 years ago, I applied to more than 1,300 jobs before I landed my dream job. And throughout that particular period of 15 months, initially I was working on minimum wage as a front desk clerk at a hotel in San Francisco. But I was very adamant and very firm that we just have this one short life to live. And I did not want to spend the remaining part of my life doing something that I was not truly passionate about. For the first 7 years of my professional career, I worked as an investment banking analyst with Citigroup and Deutsche Bank in their India, London, and Hong Kong offices. And even though I was doing well professionally, I was not really satisfied with what I was doing. And I realized that my real passion and interest lied in the public markets side and the stock market investing side. So I came to America without a job and I really gave it all that I had. And finally, I landed my dream job. And ever since then, I've been very, very happy on a daily basis. Never give up after putting in the hard work and effort, because compounding bestows its benefits on you only after a long time, after testing your patience and conviction to the fullest. This is true not only in business and investing, but also in life and relationships. So, how does one develop the tenacity and the resilience to get through the initial difficult and challenging phase? You do that by finding your North Star. When you find your North Star, that is the most important thing that sets your life's course, you finally learn where you're headed. And that is such a good feeling. It is fine for your North Star to change over time, but whatever it is right now, let it guide you. Your North Star is highly meaningful and vital in your personal context. So, aiming towards this beacon of light will bring great happiness to you every day. Former world heavyweight boxer Ed Latimore once tweeted, "When you can use your skills to make a difference in someone's life and get paid for it, that's a happy life. When you're passionate about it as well, that's a calling. The feeling is almost divine. And how do you get to experience this divine feeling? By discovering your Ikigai. Ikigai is a Japanese concept meaning a reason for being, and it refers to the convergence of four primary elements: what you love, your passion; what the world needs, your mission; what you're good at, your vocation; and what you can get paid for, your profession. In my book, I've talked about various aspects of compounding, including compounding positive thoughts, compounding good health, compounding good habits, compounding knowledge, compounding goodwill. Today, I will specifically talk about compounding wealth. The key to compounding is time and endurance. Morgan Housel has very aptly written that good investing isn't necessarily about earning the highest returns, because the highest returns tend to be one-off hits that kill your confidence when they end. It's about earning pretty good returns that you can stick with for a long period of time. That's when compounding runs wild. In a similar vein, Warren Buffett has written, and I quote, "The first thing to realize is that it takes a long time. I started when I was 11. Accumulating money is a little like having a snowball going downhill. It's important to have a very long hill. I've had a 56-year hill. It's important to work in sticky snow, and you need a little snowball to start with, which I got from delivering the post actually. It's better if you're not in too much of a hurry and keep doing sound things." And what is it that prevents most investors from doing sound things in the stock market? It is this: the sharp periodic downside volatility. And investment advisors and financial advisors alike need to educate their clients and customers that sharp downside volatility in the stock market is frequent and as normal as day following night and night following day. Look at this particular graph, which shows the maximum intra-year drawdown in the India stock market index called the Nifty 50 from 1991 to 2020. So over the last 30 years, we have had drawdowns ranging from 60%, 46%, 40%. And as recently as last year, we had a drawdown of 38%. And individual stocks fell far more during all these drawdowns. But did all this interim stock market volatility impact the long-term business performance of the wealth creators? No, because investing is all about identifying great businesses with high quality earnings growth and capital allocation and firmly holding on to them as long as they exhibit these characteristics. The stock markets do not really matter over the long run when you invest in such businesses, and most important, stay the course. Let me illustrate this with the help of an example. So in this graph, you can see that in 2008, the Indian market had a drawdown of 60%, in 2011, 26%, in 2009, 18%, 2012, 14%, and 2011, 11%, right? But if you had invested in a basket of good to great businesses like Hawkins, ITC, Titan, and HDFC Bank near the peak of the previous bull market in January 2008 and held on to them through all the volatility up to the end of the following subsequent bear market in 2019, you would have still created a lot of wealth. But if you had invested in a basket of bad businesses, then you would have destroyed wealth, irrespective of whether you entered near the market bottom or the market top. The key point here is that good to great businesses create wealth across market cycles amid all the negative headlines like rising interest rates, high inflation, geopolitical tensions, political uncertainty, and negative macroeconomic data points. The bad and gruesome businesses eventually destroy wealth, irrespective of whether the headlines are positive or negative. Trying to time the market and hop in and out to eke out that extra bit of return is a futile exercise. Howard Marks, in his memo to Oaktree clients in February 1993, wrote, the average annual return on equities from 1926 to 1987 was 9.4%. But if you had gone to cash and missed the best 50 of those 744 months, you would have missed all of the return. This tells me that attempts at market timing are a source of risk, not protection. Investors need to bear the periodic bouts of downside volatility as the price to be paid for earning superior returns from equities. Time in the market matters, not timing the market. The ability to keep investing at regular intervals, to stay the course through thick and thin, ups and downs, and bull markets and bear markets, and to not worry where the markets are going tomorrow or next week or next month is what matters. According to a study done by investment firm in India, Sage One Investment Advisors, even though the stock market index in India went up 251 times between 1979 and 2017, if you missed just 7% of the best months or 1% of the best days, your returns would have been zero. So what is the big learning that we get from all this? It is to stay the course and maintain the faith in equities as a long-term wealth creating asset class. And I've talked about the same in my book as well, that compounding is a lifelong journey, and an individual's impatience with his or her investment process could lead to a fatal decision and bring the journey to an abrupt end. Stay the course and remain faithful to your personal investment philosophy and your individual process. Focus is the key to success. Low and negative return years are a routine part of the investing game. You have to be present in this game for a long time to win. The key is to avoid getting thrown out midway because of reckless decisions. If we continue to earn above average returns over long periods of time and avoid permanent loss of capital in bear markets, the magic of long-term compounding ultimately will take care of the outcome. And what is this magic of long-term compounding that I'm referring to here? And how can it help us achieve financial independence? In his famous talk from November 2018, veteran Indian stock market investor Ramesh Damani talked about the incredible power of compounding. In that talk, he referred to the rule of 72, which I've talked about in my book as well. According to the rule of 72, we double our capital every 3 years by compounding at 26%, 10 times in 10 years, and 100 times in 20 years. And along the way, we will achieve financial independence. Time is power in investing. Let me illustrate this with the help of an example from my book. Paul is 18 years old. He gets an after-school job and opens a Roth IRA savings account in which he saves $5,000 per year till the age of 70. Paul is a know-nothing investor, invests in cheap, low-cost index funds, dollar-cost averages, reinvests his dividends, and earns the same nominal return the US market has earned for the last century, which is around 10%. As a result, Paul ends up with a little more than $7 million in accumulated wealth. Paul's friend Peter is also 18 years old. He also gets an after school job, but he doesn't save anything as he wants to engage in instant gratification and conspicuous consumption during his fun years. Peter waits until he is 30 years old, at which point he opens a retirement account, saves $5,000 per year in it, and then does all the same things as Paul. Now, note that at this particular point of time, Peter is only $60,000 in total contributions behind Paul, and he still has 40 years to go before he turns 70. So he figures it isn't too bad. When Peter reaches retirement, though, he has only $2.2 million with him. So as you can see, a merry $60,000 difference between Paul and Peter in cumulative investment turned into a $4.8 million difference in final net worth. This example shows, as John Bogle would call it, the relentless rules of humble arithmetic. There is a mathematical equation for wealth creation, and it goes like this. Add to your savings every month, subtract and eliminate biases, greed, and wasteful expenses like taxes, brokerage, and statutory charges. Multiply your time horizon. Divide across asset classes as appropriate for your stage in life and your personal circumstances, and achieve the exponential power of compounding. The way to wealth is to buy right and hold on. By doing so, an investor minimizes paperwork, transaction costs, and capital gains taxes. To reap genuine riches, one needs to invest in long-term winners and hold on for compounded tax-free growth. No more effective tax haven exists than unrealized appreciation in a long-lived, soundly growing company. Compounding combined with patience is an incredible force over time. In the course of our daily lives, we treat a 2% charge as a small amount. In the world of investing, however, 2% is a huge deal. It has the potential to transform your life completely. To illustrate the huge impact a tiny 2% of savings in frictional costs can make in the long run, let's assume that you invest $30,000 today for 40 years in 3 fixed income instruments yielding 7%, 9%, and 11% respectively. This graph shows how much you would have at the end of 40 years. At 7%, you would have $0.4 million. At 9%, you would have $0.9 million. And at 11%, you would end up with more than $2 million. No wonder Benjamin Franklin very aptly said, beware of little expenses. A small leak will sink a great ship. And now it is the turn of equities, the greatest long-term wealth creating asset class. This figure shows what would happen if you invested the same $30,000 today for 40 years in a portfolio of high quality stocks with 15% earnings growth and 2% dividend for a total of 17% return. In this case, you would end up with more than $16 million in accumulated wealth. This is compounding wealth in action, and it goes to show the incredible wealth creation potential of equities in the long run. And mind you, in our example, we assumed that you did not make even a single additional contribution throughout your earning years. Just imagine how your compounding engine will skyrocket once you make regular contributions too. The fan figure then becomes truly astonishing. The effects of compounding are too small to be noticed until they are too large to be ignored. Instead of treating dividends as free money and engaging in mental accounting, investors should resist instant gratification and always immediately reinvest their dividends. Reinvesting your dividends through a dividend reinvestment plan is a great way to take maximum advantage of the power of long-term compounding. A dividend reinvestment plan automatically uses your dividends to buy more shares of the holdings in your portfolio. You should enroll for the dividend reinvestment option. You gain the benefit of dollar cost averaging, and after enough years go by, the benefits accrue in the form of higher dividends that may be a multiple of the original investment. This is the power of compound interest. In addition to earning returns, money you invest, you also earn returns on those returns over time. This compound growth is what causes your wealth to snowball over time. When we reinvest dividends, we enjoy the power of double compounding or compound interest on steroids. For many investors, this is their first bull market. Personally, this is my third bull market experience, and it should be avoided as one navigates through a bull market, which I will share today with all of you. Howard Marks has very aptly said that you can't predict, you can prepare. We cannot predict the movement of interest rates or the stock market or the economy, but we can definitely get a broad sense of where we stand in the market cycle. The quality of investor portfolios is a valuable indicator of the prevailing market psychology. As a bull market matures, many investors tend to move their portfolios from high quality stocks with steady growth and high return on equity to cheaper but higher growth stocks with poor management quality and inferior return ratios, and then to commodities and cyclicals, and then to turnaround situations that are currently loss making, and then to micro caps with limited track records of operations, and finally to highly leveraged companies with projections of rapid revenue growth. At this point, the bull market usually tops out, and at the end of the euphoric phase, most investor portfolios have only junk left in them. During the bear market that follows, both quality and junk stocks fall hard. Quality eventually bounces back in the subsequent recovery, whereas junk stocks stay low for many years until the next bull run takes over. Only after going through the pain of a couple of such cycles can an investor resist the incessant urge to move down the quality ladder and chase quicker returns. The greatest learnings always come from a bear market, and these lessons bear fruits for an entire lifetime. Never let a bear market go to waste. A bear market teaches the reality of the harsh math behind compounding in reverse with fraudulent management teams or weak business models. So, the first big lesson is to avoid going down the quality curve in your portfolio due to greed of trying to make very quick returns in the short term. The second big mistake to avoid during a bull market is to avoid value traps. And Benjamin Graham, the father of value investing, had written about value traps in the 1951 edition of his magnum opus, Security Analysis. He wrote, and I quote, "We shall conclude with a practical observation that is based on experience rather than theory. When the general market is high, there are always a number of individual issues that appear definitely undervalued by objective standards, and consequently even more attractive in contrast to the inflated level of other stocks. The analyst may be tempted to recommend these as unusual opportunities. Not only may the neglected security continue neglected for the remainder of the bull market, but when the downturn comes, it is likely to decline in price along with the general market and to fully as great an extent. In a word, beware of bargains when most stocks seem very high." I've talked about value traps in my book as well. Most of the time, switching from a high P stock to one with a low P proves to be a mistake. Value traps are abundant and all pervasive. I've learned to respect the market's wisdom. Everything trades at the level it does for a reason. High quality tends to trade at expensive valuation, and junk or poor quality is frequently available at cheap or the harmful, optically cheaper on a relative basis valuation. It took me many years to learn this big market lesson. Expensive is expensive for a reason, and cheap is cheap for a reason. So the learning we get from here is avoid value traps or melting ice cubes. Just in the search of cheap valuations or dirt cheap valuations in a bull market, try avoiding going down the quality curve. If something is super cheap in this information age, that is probably a strong reason for it. The next big learning is the need to adapt to changing realities. Marcelo Lima, in his 2018 Q2 letter to Heller House clients, wrote, and I quote, "The traditional value investor mentality of buying cheap securities, waiting for them to bounce back to intrinsic value, selling and moving on to the next opportunity is flawed. In today's world of instant information and fast-paced innovation, cheap securities increasingly appear to be value traps. Often they are companies ailing from technological disruption and long-term decline. This rapid recycling of capital also creates an enormous drag on our after-tax returns. In addition, by focusing on these opportunities, we incur enormous opportunity costs by not focusing instead on the tremendous opportunities created by the exceptional innovation S-curves we are currently witnessing." And I've talked about this innovation S-curves in my book as well. As innovation S-curves get steeper, adoption cycles also have gotten much faster. Today, new business models make money, and they are here to stay. Although the adoption cycle for social media is different than it was for the radio or electricity, many investors project the past onto the future and end up missing great opportunities. The journey from tangibles to intangibles is the true essence of the journey of investing. The next key bias to avoid in a bull market is anchoring bias, recency bias, and FOMO, or the fear of missing out. Many times, people who have seen a bear market are unable to participate in the subsequent bull market due to price anchoring. Focus on current facts and value. not the past valuation or the past stock price. I've talked about anchoring bias in my book as well. A common and highly irrational anchoring bias among investors occurs when they aim to buy a stock which they expect to go up hundreds of percentage points over time, only at an arbitrarily fixed desired purchase price that is a bit lower than the current market price. These investors act penny wise and pound foolish and end up incurring huge opportunity costs in many cases, similar to those who defer a justified sale of a stock solely to make it a long-term holding and save some short-term capital gains tax. If this sounds familiar, then it is probably because we have all been there before. It is critically important to resist greed, envy, impatience, and FOMO during a raging bull market. If you still want to continue riding the bubble valuation stocks in your portfolio, use trailing stop losses or the break of an important moving average as an exit strategy for them. The key point here is that if you have bubble valuation stocks in your portfolio and if you feel the urge to sell them, have a systematic process in place. For example, you can use a trailing stop loss of 15% to 20% from the peak price as an exit point. Or you can use the break of an important moving average, like the 200-day moving average. Or if you want to tighten it up a bit more, you can use the break of a 50-day moving average. But whatever you do, have a systematic exit strategy in place based on price. If there are no fundamental reasons to sell apart from valuations, then you can have a price-based exit strategy. Over the last 14 years, there have been many significant learnings from my investing journey, and I would like to share some of the most important ones with all of you today. The first one is that accounting profits or reported profits in the income statement are becoming less useful in a digital world. I'll again quote Marcelo Lima from his 2018 Q2 letter. Cheap is a poor proxy for value. The new business models, software as a service in particular, are not well suited to traditional GAAP accounting. Here's why. If distribution costs are zero, the optimal strategy is to gain as many customers for your software product as quickly as possible. In digital businesses, there are increasing advantages to scale. And many of these companies operate in winner take all or winner take most markets. The name of the game is thus to build, grow, then monetize. Frequently, this means spending a lot of money in sales and marketing, which depresses reported earnings. Thus, SaaS companies spend to acquire customers upfront and recognize revenue from those customers over many years. This mismatch burdens the income statement. Some of the most successful and highest performing stocks in the SaaS world have spent many years growing despite producing no meaningful accounting profits. But in reality, they are very profitable in terms of unit economics once they stop reinvesting every dollar generated into further growth. The traditional method of screening for low P stocks doesn't work in this scenario. So the first big learning here is that one needs to dig deeper and go beyond the reported accounting numbers to understand the unit economics of the business. Traditionally, there have been three sources of advantage for the individual investor. The first of which was the information advantage, which has basically been eliminated with the rise of the internet and widespread information. The second advantage is analytical advantage, but with the entry of more and more smart people in the investing field, that advantage is quickly getting compressed. But the third advantage, which is the behavioral edge or the behavioral advantage, is one which in my view is durable and will sustain for a long time to come, because human behavior has never really changed in centuries. And I've talked about the importance of behavior in my book as well. Over the years, I've come to appreciate the fact that investing is a field of simplifications and approximations rather than of extreme precision and quantitative wizardry. I also have realized that investing is less a field of finance and more a field of human behavior. The key to investing success is not how much you know, but how you behave. Your behavior will matter far more than your fees, your asset allocation, or your analytical abilities. Even low-cost index funds won't be able to help you if you succumb to behavioral biases. Most of the time, the real risk is not in the markets, but in our behavior. Emotional intelligence has a much bigger impact on the success or failure of investors than the college they attended or the complexity of their investment strategy. Most of the time, their high intellect works against them because they become so sure of themselves and their abilities that they cannot change their mind. It is always a struggle to keep things simple in a complex world. That struggle is more pronounced for the highly educated people. The smarter you are, the better you are at constructing a narrative that supports your personal beliefs, rationalizing and framing the data to fit your argument or point of view. You may be smart, but not necessarily intelligent, because intelligence is the ability to arrive at accurate cause and effect descriptions of reality. The next big learning over the years has been the importance of prudence or sensible behavior. Concentration coupled with intelligent risk taking and good luck creates big wealth. Diversification coupled with humility and contentment preserves big wealth. Once you have achieved financial independence, it is important to realign your portfolio to have the majority weight in quality businesses. After reaching a state of financial prosperity in life, ensure that you take all necessary steps to avoid being thrown back to the starting position. Achieving success and then losing everything has a far greater emotional impact than failing before ever having achieved success. And very importantly, the key to a lifetime of investment success is not to make brilliant or complex decisions, but to avoid doing foolish things. Most of the great investors believe in the dictum, strong beliefs loosely held. And the day I began being patient with holding my winner stocks and impatient with the non-performing businesses and managements, my wealth creation journey gained major momentum. Portfolio turnover, and justified by facts, is not a sign of weakness. It is a sign of constant learning. Most investors wait to recover what's gone rather than retaining what's left. They don't realize that loss recovery does not necessarily have to be made from the same stock on which the loss was made. If the story is gone, simply book your losses and move on to a better option. Continuity of compounding is the key to success in this long-term game. After buying a stock, forget what you paid for it, or this knowledge will forever affect your judgment. You need to materially adapt when losing and remain faithful when winning. If you have the discipline to do just these things, you will succeed as an investor. And here, let me acknowledge that even after many years of investing experience, I still make mistakes of commission many times when adding new stocks to my portfolio. But the biggest improvement is that now I get rid of this mistake very early instead of living in hope and incurring big opportunity costs. So the next big learning here is to always have an open and flexible mindset and to embrace and accept reality for what it is. The next big learning over the years has been to learn to respect the wisdom of the crowds and the wisdom of the markets. The market is a great leading indicator. Over time, as an active and highly engaged investor, you develop what is known as a feel for the market. If a group of stocks from a single industry are all rapidly going up together at the same time for a few successive days in a row, then that is a strong signal that the fortunes of that industry may be turning around and should be investigated further. Let me illustrate this with the help of an example from last month when I tweeted. So on that particular, on 21st January last month, all the leading auto stocks in India were going up rapidly as a group. And that was basically giving the signal to the market participants that the industry recovery is underway. And it turned out to be true. The market turned out to be right in its wisdom, because subsequently during January and February, almost all the auto and auto ancillary stocks reported very, very strong earnings. So the big learning here is always pay attention to what the market is trying to tell you and respect the market's wisdom. The next big learning over years has been to learn to identify companies with the capacity to suffer. So noted value investor Thomas Russo has coined the term the capacity to suffer, referring to companies that are reinvesting to build long-term competitive advantage at the cost of short-term depressed earnings. And I've talked about those kind of companies in my book as well, in the chapter on delayed gratification. And I quote, investors generally overlook businesses that are doing things that will create significant incremental earnings 1 to 2 years from now, because they don't want to wait that far out of the future and currently are suffering from low initial margins in those new initiatives because the earnings growth is back-ended. Even if they execute well, they will see little reported earnings growth for the next 4 to 8 quarters and may even see a decline resulting from incremental depreciation, lower initial margins because of low capacity utilization. Even if they are expected to experience an exponential jump in earnings growth after that, The stock markets generally do not initially increase the market value of these businesses. They do re-rate them, however, around the time when the earnings growth is clearly visible. As investors, we get an edge over competition if we pick these companies and have the patience and conviction to hold them. Although these businesses are clearly undervalued on a longer term basis, it is psychologically challenging to invest in them and even more so to hold on to them. These difficulties result in a lack of investors and the subsequent mispricing of these stocks because the price discovery is weak when investors' attention on these stocks is low. And let me illustrate this with the help of an example from my portfolio. Last month, I tweeted that one of the portfolio companies in shared in a Raj Ratan Global, their revenues were up 52%, margins had expanded more than 200 basis points, and the net profits had grown almost 100% on a year-on-year basis. Now, what Raj Ratan Global was doing was, throughout 2018 and 2019, they were engaging in a very big capacity expansion. But throughout that particular period, the company did not have any earnings growth. So the market was simply ignoring the stock in spite of its intrinsic value going up because of the large capacity expansion. And one of the ways the investors can get big multi-baggers in the stock market is if you can pick these companies which are undergoing large capacity expansions during an industry down cycle, you get to pick them at low market caps and low valuation. After that, you just need to be patient and hold on and simply hold on to them till the next industry upturn. And that is how you get multi-bagger returns. If you see this particular price chart, you'll see last year throughout March, April, May, June, there were negligible volumes in Raj Ratan Global Wire. But once the capacity expansion came on stream and earnings growth started picking up, there was a pickup in volumes over time. And over the last 12 months, Raj Ratan Global has delivered more than 90% returns. This is market data as of yesterday's market close. The next big learning over the years is that investing is all about pattern recognition. The patterns tend to keep repeating again and again. Note this particular extract, which I just shared a few slides ago, that the stock markets generally do not initially increase the market value of these businesses. They do re-rate them, however, around the time when the earnings growth is clearly visible. On 8th of January last month, a company in India, Ultramarine and Pigments, announced the commencement of their expanded production capacity. And that day I tweeted that big capacity expansion along with low valuation and earnings growth from the new capacity plus margin expansion should now lead to PE re-rating, because this particular capacity expansion was done in the more higher margin products for this company. So now watch. The company made the announcement on 8th of January and the stock of Ultramarine Pigments has gone up almost 40% since that particular date. Again, this is market data as of yesterday's market close. So like I said, investing is all about pattern recognition. All that an investor had to do was be alert and diligent and wait for such an announcement. The next big learning from the market over the years is that investing is all about the rate of change. Warren Buffett has very aptly said that a business should be viewed as an unfolding movie, not as a still photograph. In investing, always focus on delta, that is on the rate of change in earnings growth and its underlying quality. Look at this snapshot of a company from India, and it's a century-old company. It commenced operations in 1919. Until 2000, it was engaged in the fertilizer business, which was more of a regulated business, which got subsequently shut down. And from 2005 to 2011, the company shifted its focus from fertilizers to producing low-margin bulk chemicals. And since 2011, the company has been focusing on expanding its business into higher margin specialty chemicals. And if we see this extract from its 2020 annual report, the company is now saying that they envisage an operating margin of 30% and a payback period of no more than 30 years. And to expand its capacity in the specialty chemical segment, the company has planned a capital expenditure at its available land parcel in Dahej, Gujarat, India. Okay. I'll reveal the name of the company shortly, but here is another data point. So on 10th of February, that is just 10 days ago, this company uploaded a presentation on the Indian stock exchanges in which they detailed their ongoing capital expenditure program. And note what I just said a few slides ago, that the stock markets generally do not initially increase the market value of these businesses which are displaying delayed gratification. They do re-rate them, however, around the time when the earnings growth is clearly visible. Once the earnings visibility became very high after this particular presentation on 10th of February, the stock of this company, Dharamsi Morarji Chemicals, has gone up 50%. And again, this is market data as of yesterday's market close. So as you can see, investing is all about pattern recognition, and it's about the rate of change. I would now like to speak about how value investing actually resembles a life discipline. And over the years, I've come to realize that the best things to learn from Warren Buffett have got nothing to do with investing. If there is one thing that has benefited me immensely in my investing, trading, and wealth creation journey over the years, it is this: listening very attentively to and learning from peers, seniors, and juniors who are much more smarter and hardworking than me. One should always be humble with everyone. Humility is the greatest book as well. The more you reach out to and associate with individuals, whether younger or older, who are better and smarter than you are, the more you will learn and the faster you will improve. It is better to be an average guy on a star team than a star on an average team. The former will be better for you in the long term, the latter is just an ego trip. If you are the smartest person in the room, you are in the wrong room. It is wiser to be with better people and to be uncomfortable than to limit yourself to a mediocre circle just to feel comfortable. The people closest to you play an outsized role in your level of success or failure, so choose wisely. You are, after all, the average of the 5 people you associate with the most in your life. The value investing discipline has certain final aspects that we come to realize and appreciate only with the passage of time and with experience. With the passage of time, we learn to recognize that value investing is not merely about stocks and business fundamentals. It is a life discipline. And I've illustrated the same in my book through a section on overrated and underrated behaviors. Knowledge is overrated, wisdom is underrated, intellect is overrated, temperament is underrated, outcome is overrated, process is underrated, short term outperformance is overrated, long term adherence to one's investment philosophy is underrated, gross return is overrated, stress adjusted return is underrated, upside potential is overrated, downside protection is underrated, maximization of return is overrated, avoidance of ruin is underrated, growth is overrated, longevity is underrated, entry multiple is overrated, exit multiple is underrated, price to earnings ratio, the widely available P ratio, is overrated, duration of competitive advantage period is underrated, categorization of stocks into large cap, mid cap, and small cap is overrated, categorization of businesses into great, good, and gruesome is underrated, being more frequently right than others is overrated, being less wrong than others is underrated, forecasting is overrated, preparation is underrated, confidence is overrated, humility is underrated, conviction is overrated, pragmatism is underrated, complexity is overrated, simplicity is underrated, analytical ability is overrated, personal behavior is underrated, having a high income level is overrated, inculcating a disciplined saving habit is underrated, competition with peers is overrated, helping them is underrated, large personal net worth is overrated, good karma is underrated, talent is overrated, resilience is underrated, being the best investor is overrated, being the most authentic version of yourself is underrated. I would like to conclude with two key messages from my book: that the goals of investment should be happiness, joy, growth, intellectual satisfaction, and eventually peace and serenity. Wealth and financial prosperity are natural byproducts of lifelong learning. And many people achieve success, but to sustain the same and potentially build on it over an entire lifetime requires humility, gratitude, and a constant learning mindset. For any feedback or queries, feel free to connect with me on thejoysofcompounding.com. I can also be reached on LinkedIn and Twitter. readers can get their copy of the book on Amazon, Google Play Books, and Book Depository. With that, I come to the end of my presentation. Thank you, Rupa.
Wow, wow, wow. That was absolutely amazing. So insightful. And of course, Gautam, there are a lot of questions waiting. So I will let Kelvin and Serging lead the panel discussion. And when they need a breathing break, I will, slip in the viewer questions. Thank you so much, Gautam, for your insightful presentation.
Thank you.
Hey Gordon, your presentation was really incredible. I think you really showed us a way that simplicity really beats the complexities in our compounding journey. Which is a total opposite to the world that are promoting very complex way to make money. So, what you shared is highly relevant. It is a format that I believe anyone could really apply and obtain success over time. So we are very lucky to have you. So I'll ask a question, and Sergin will ask a question, and it will be back to me, and it will be back to Sergin again. So the first question that I have is that I read your book over here. It's a great book. So I believe that our audience is very likely to ask you finance-related questions. But where I think is important is that it is your journey to becoming who you are today. You are frugal, you are far-sighted, you're humble, and you are filled with wisdom as well. So if you could really narrow down to 2 to 3 key events in your life that built the Gordon Bed that we know today, and what were some of the lessons we can learn from those events? So yeah, I have this question for you.
So at the very beginning of the presentation, I talked about my journey as well. That when I basically for the first 7 years of my professional career, I was working in a job which was paying very well, but I realized, and this is a bit philosophical, I realized that money is not everything in life. It is important, but what is more important is the state of constant peace and happiness. Basically, we live 24 hours in our mind, and unless our mind is at peace, we can never achieve true happiness. So since we spend the bulk of our daily lives in our jobs, it's very important that we love what we do and do what we love. So that was the context in which I basically gave up everything in India and came to America 6 years ago without a job in hand. And in the first 6 months, I applied to 3 stock market job interviews, did not get selected for them. But throughout this phase, I was getting a lot of interview calls for high paying investment banking jobs, my previous field of work. But I was just adamant and firm that I do not want to do something which I do not want to do. So I took up a minimum wage job as a front desk clerk at a hotel in San Francisco, where I worked for 15 months. And I still remember every single night, I used to apply to a minimum of 3 jobs online. So if you do the math, over 15 months, I had applied to more than 1,300 jobs. And Kelvin, whenever we fill up the application form, attach our resume, and click on the submit button, there is always so much hope attached behind every single job application. To face rejection more than 1,300 times and still keep on going, it's only possible if you're truly passionate and determined about what you want to do in life. So after, that is basically how compounding works. It'll test your patience and conviction to the fullest. But as long as you just have faith and stay the course, you will achieve success. So that is what happened with me finally in December 2016. I landed my dream job after 1,300 attempts. And life has been blissful ever since. I even got a promotion 2 years ahead of schedule. And that is only possible because I'm simply loving what I'm doing every day. And that is why I'm able to produce very good work. So there's a virtuous cycle, which basically kicks off in motion. And throughout my initial 7 years of working, I was saving money, investing. Over time, it amounted to a decent sum. And as a mark of my gratitude for the investing community, I decided to self-publish the first edition of my book, and I charged no royalty. I basically was selling it at cost. The idea was to give back to the investing community and compound goodwill. I had basically understood this concept from Guy Spare and Warren Buffett as well, that if you do good things for people early in life, the effect starts compounding. And for even when I was earning minimum wage in San Francisco at that hotel job, I still remember I used to contribute small sums of money to local charities like $10, $20, because it's not the amount of money you are contributing, it's the amount of love that you're putting into it. The same thing was with the book as well. So Wonder of Wonders, the first edition, edition, became very, very popular. And then during a book fair in Omaha, Nebraska in 2018, Columbia Business School Publishing. They are basically in 2019. Sorry, Columbia Business School Publishing. One of their lead people came down to Omaha and met me, and then offered me a contract for publishing my book. So that is how the Columbia Business School edition of the book got published in 2019. And just recently, a few months ago, HarperCollins India has also purchased rights to the book for the Indian subcontinent, and they have released a more affordable paperback version of the book in India, and it has become a bestseller in India as well. So basically, life cannot be understood forward; it can only be understood looking backward. Eventually, things do work out. But the important thing is to just maintain the faith. Just have faith that as long as you're doing the right thing, good things will eventually happen to you. And one important thing I would like to share here is that there are many good people in this world who want to do good things for people, but they lack the financial resources to do so. But once a person with a good heart gets access to a lot of capital and money, I mean, those people can try to change the world in their own small way. That is what I basically tried to do with my first edition of the self-published book and the subsequent editions as well. So just be humble, learn from everyone, try to help everyone in your own individual capacity, and just watch the magic of compounding goodwill over time.
Oh, that's amazing. To Saji.
Yeah, Gautam, thanks again for the wonderful presentation. It's lovely to hear you mention the concept of Ikigai, which is something that I believe in deeply myself as well. It's something also I've been telling my friends for a very long time. But one thing I've noticed is that it's uncommon, especially I think for people in Singapore, to find their Ikigai. So I was just wondering if you have any thoughts about, is there a way for people to be able to discover their Ikigai earlier rather than later?
It's very simple. Ikigai is anything. Basically, your Ikigai is the intersection of what you love, what the world needs, what you're good at, and what you can get paid for. So if there's anything which makes you jump out of bed every morning, and if it is a skill which you can monetize, I think basically you've discovered your Ikigai. Like during my first 7 years of my job career, there were days and nights when I was literally up till 2, 3 a.m. in the night reading annual reports and reading up on company research reports and filings. So I had understood that, okay, this is what is making me wake up at night. This is what I'm looking forward to the next morning. So it's very simple. Once you find something which really excites you and which you can monetize and which can pay you well, I mean, that is what is Ikigai. All these 4 elements which I mentioned, they have to be in place. The world has to need it. You have to be good at it. You have to love it, and you should get paid for it. So this is basically the 4 critical elements of finding your Ikigai.
Awesome. Thank you so much.
Gautam, if I may slip in, some questions that are coming in from viewers. Now, you have talked about quality businesses, but I mean, often we see, in fact, especially in today's world, many of these quality businesses seem to have run up in market price. However, fundamentally, there is nothing really wrong in these businesses. So how do you think about situations like these? Some of our viewers, they want to know, like, would you think about, just holding on and letting compounding play its role, or would you think about, exiting because these businesses are overvalued right now? What is your thought process?
So one thing which I would like to mention is that if you want to go wrong in the markets, go wrong on valuation, but not on quality, because eventually in the bear markets which follow, both quality and junk will fall, and eventually quality will rise again. As regards, quality, and see, quality always comes at a very, very high price, but it's not as if there is a dearth of opportunities in the market at any particular point of time. There are 5,000 to 6,000 companies to choose from. And if you are having problems selecting good quality companies from that, then that there is a problem. There is no lack of opportunities in the market, but you have to understand that you have to equate the quality of the earnings growth with the evaluation as well. So what does quality refer to? First of all, let's understand what does quality refer to. Quality means predictability of earnings, longevity of earnings, non-cyclicality of earnings, high returns on capital, and conversion of all the net profits into cash. So that is basically what we define as a very high quality businesses, right? So today you'll see a lot of these high quality internet and software companies trading at multiples of revenue because they're not producing any profits, right? Any meaning accounting profits right now. So the way to analyze these businesses is you have to look at the long-term unit economics and basically then adjust them into a steady state scenario once all the investment phase is over. Then you need to discount those free cash flows from the future into the present. That is basically how you can understand these kind of businesses, because all these high growth businesses, their free cash flows lie in the future. So unless you have a very solid understanding of the unit economics, you should not invest in them. One more thing. So there are many multiple routes to heaven in the stock market. If you are not able to find a very high quality business at a reasonable valuation, then it's totally fine to make money from commodities, cyclicals, special situations. I mean, if you allow me, I can actually share an example as well, or I can just give so there's a particular company in India, an auto ancillary company in India, which is getting merged with a bigger auto ancillary company. And based on the merger ratio, there is a clear 30 to 40% upside once the merger gets completed in the next 2-3 months. Now, why is this 30-40% discount present right now? It's because people are so impatient. They do not want to wait for even 2-3 months for the merger to get over. So the market offers a constant stream of never-ending opportunities. You just need to put in the work, and the person that turns over the most rocks wins the game, like Peter Lynch said. So you just need to keep hunting for opportunities. Don't just blindly chase quality at upside valuations. Only invest if you find reasonable valuations. Now, the definition of reasonable varies for different kind of people. If I find a company which is at a 10-15p multiple, which is expected to grow earnings at 10% for the next 10 years, and if I find a stock company which is expected to grow earnings at 30% for the next 10 years, available at 30p multiple, I will go with the latter, where the longevity of the earnings growth is predictable. So always focus on the longevity and the growth aspect. That is how you understand whether a particular entry valuation is reasonable or not. It's case to case basis.
Thank you. Kelvin?
Oh, yeah. So this question is a bit tricky, but I think it's a very good question to actually ask you. So I think with a proper investing framework and by following the compounding process, I do believe that everyone in the audience, we will all achieve financial freedom eventually. Unfortunately, in reality, this is not true because we tend to sabotage ourselves with our psychological biases. So I think it's very interesting and relevant that you talk about the psychological biases. So Gordon, for you, because I think you're very aware about those psychological biases. So I just want to find out from you, how do you gain the process of gaining awareness of your own psychological biases and finally overcoming them? Is it a unique way whereby you do a certain reflection?
That's a good question, Kelvin, and a very relevant one. So first of all, how to become aware of these biases? It's simple, through reading. And vicarious learning is very, very valuable. Like Charlie Munger says, right? You do not need to pee on an electric fence to understand not to do it. So always learning from others is very valuable. And there is a ton of literature on this particular subject from Mr. Kahneman and various other very eminent authors. Charlie Munger's Psychology of Human Misjudgment is a classic. There also we can get a lot of ideas. Richard Thaler has written a lot of work on behavioral biases. So has Dan Ariely. So there is a ton of literature out there to make yourself aware of these behavioral biases. And how does one gain control over these biases, and how does one avoid falling into this any of these biases? You do that by following what is known as a checklist. And I've devoted an entire chapter to checklists in my book as well. You simply follow those checklist items one by one. Then you'll have a very good chance of minimizing any incidents of these behavioral biases. So basically the idea here is to just have a systematic process in place to avoid all these behavioral biases, and a checklist is one of the best ways to avoid doing that. One more important way to avoid hindsight bias is to basically have a personal journal in place, in which you write down the original thesis for making a particular investment, and later on when journal and see that did things play out as per your expectations or not. Because many a times we'll see on favorable outcomes that the reasoning behind it was very different from what we actually thought. So a journal helps us remain humble, and helps us be realistic and practical and aware of the uncertainty in the world. Things don't always turn out the way we expected them to, but at least by referring to the journal, we can avoid hindsight bias and just be very true to ourselves. So checklists and journal, these are the two ways to avoid these biases.
Thank you so much. Okay, Sajin.
Yeah, there's this one of my favorite podcasts is actually the Invest Like the Best series run by Patrick O'Shaughnessy, and one of my favorite questions from the podcast is him asking his guests, what's the kindest thing that somebody has done for his guests. And yeah, I would love to hear it from you. Like, what is the kindest thing that somebody has done for you, Gautam?
Oh, there have been so many actually. There are so many people I need to thank. And if you've seen my book also, I've devoted an entire chapter. It's titled "The Importance of Choosing the Right Role Models, Teachers, and Associates in Life," in which I've paid tribute to my parents, my investing, colleagues and peers. So, throughout life, right from our childhood, our parents do very kind things for us. They do give us a lot of love and affection. Later on in our school and college days, it's our colleagues and friends. And then later on in our profession, it's our professional colleagues. So it's actually been throughout. I think it's especially throughout, from childhood to now. It's like a combination of all these people: parents, friends, professional colleagues. I mean, I'll just give a very recent example. I'll give a very simple example to illustrate. So if it were not for the kind guidance and help of my investing peers and colleagues, then my personal portfolio would never have been able to do as well as it did during the bear market in India from January 2018 to March 2020. And I hope to keep learning from them throughout life, just like I did last year when I got to learn about investing in warrants, partly paid shares, and differential voting rights for the first time in the Indian stock market. And all those three opportunities turned out to be highly profitable. So the idea here is to just be humble and helpful with everyone, and kindness will come automatically. If you're associating yourself with good people, eventually you get back far more than what you give. So I cannot really pinpoint one single person, but it's a combination of all these people from childhood to today.
So very awesome. Seems and it's wonderful to hear that you have so much gratitude for people around you and the things that they've done for you. Personally, I think that having gratitude towards all the positive things in life is also a very big, driver for growth in our own personal lives as well. So yeah, thanks again, Gautam.
Sajin, I'll tell you personally, nothing teaches you gratitude better than an empty wallet and a hungry stomach. And during those initial, months and years in the US, at that during the difficult and challenging phases in your life, that is when you get to realize, who the true people are in your life, who truly you should maintain relationships with for the rest of your life. And that is when you get to realize the importance of gratitude, just being grateful for everything that we have in life. So inhale blessings, exhale gratitude. That is the mantra with which one should lead life.
Oh, that is so wonderful.
That's so amazing, Gautam. In fact, I remember reading, somewhere that during your initial days in the US, when you did not have much money, the only thing you did not want to compromise on is your reading. And I think there was the book that you were waiting for, and you somehow found out that it's available either in a library or in a bookstore, I can't remember, which is a bit far. And I remember how, you took the bus at an odd hour. And, if you can just narrate this story, I'm sure our young investors will find it very inspiring. The extent.
So it was a book written on Warren Buffett by Laura Wright, by the editor of his annual letters. And basically, I had found out that during a particular night in San Francisco that there was a more newer edition of the book which had come out, which had one single additional chapter at the end. So I did not want to spend money on a cab ride. So I just went to the local bus stop. And I got drenched in the rainstorm, even while having an umbrella with me. And I traveled all the way downtown to a Barnes and Noble bookstore to read the final chapter of the book inside the bookstore and save a few dollars. And in fact, it was that very night that I discovered my Ikigai, because there was such a sense of exhilaration and delight that night that yes, this is what I want to do. This is what drives me. This is what gives my life meaning. And it was a wonderful moment of self-discovery. And life has been great ever since.
That's so awesome. Now, I actually have a question to all our three panelists here. So I'm referring to a picture in Gautam's book, and the title goes, "Bull Markets Climb a Wall of Worry." I mean, there is so much of negativity that we are constantly confronted. The media keeps throwing bad news at you, and you guys, all three of you, you're very young. How do you develop the maturity to keep the noise out? uh, yeah, let me start with Gautam, and after that, if Kelvin and Serging, you also can add your, how do we keep the noise out?
Very simple. Just focus on what is important and knowable. What's important and knowable is the fundamental performance of your portfolio companies, and everything else is noise. It's as simple as that. So, for example, I don't watch any of those business channels. All that I do is read good books and go through the annual reports and filings of my portfolio companies and of any new opportunities. So I just focus on what is important and knowable. Where the interest rates are headed, the stock market is going, where the economy is going, are all important but not knowable, right? So by devoting our energy only to what is important and knowable, we are able to filter out all the noise. And there is a ton of noise, trust me. I mean, with the advent of social media, there is no dearth of noise in the world right now. So one has to have what I mentioned as the behavioral edge, just basically behaving sensibly, so to speak.
Excellent. Kelvin, how do you handle noise?
Well, it's really about looking at history. I think I used to study history a lot in school, so I love it a lot. So I guess ultimately, to me, it's really simple. It's really believing in humans, right? In all of us, right? Believing in our ability to actually create a better world, to move forward from our past, right? And I think the history has actually demonstrated that, right? We have embedded electricity, right? Embedded color TVs, cars, airplanes, and knowing that we will always have victory over things, right? We gone through SARS, Ebola, and there's no question in our mind that we'll always overcome things, right? So there's no question in my mind that COVID-19 will be over. So I think at the end of the day, when we look at businesses that have tremendous compounding process, it is because they are always doing something different, that's doing something unique that pushes society forward, and that they are actually being valued on that basis alone. So I think when we are talking about investing in people, investing in the stock market, we're actually investing in people and believing that people are always trying to make the world a better place, a place that's more efficient, more productive. And I think that's always how I think about it. And I totally agree with Gautam as well. There's a lot of things that we can't control. So there's this framework that I use, noise versus signal, right? In fact, there are so many noise around the world, right? That I think sometimes we may burden ourselves with excessively, but really focusing on the signals to see that, hey, despite all the things that have happened in the past that really look like a terrible year, last year was a terrible year, but moving forward, it's just going to be a small blip, and we might even forget about COVID-19 for the next few generations down the road. So that's how my thought process is, and that has been guided my decision since then.
Let me just add a few one more point here. So remember this particular graph I had presented early in the presentation. So all these red bars are basically what is noise. This is what the noise which I was referring to. So between 2008 and 2012, you had such big drawdowns, but did it make any difference to the wealth creation by good and great businesses? No. This is what is this downside volatility is the noise. This is what makes investors avoid doing sensible things and sound things in the market. But once you zoom out and take a long-term view, all these just end up looking like blips in the long-term chart of stock market and human progress. So one just needs to, the key to minimizing noise is to just have a long-term orientation. That is going to be the biggest single advantage for all investors.
Amazing. Serging, what's your thought? I know you do it quite well. So how do you eliminate noise?
So I think I would call myself a long-term. In fact, I would say that I'm a long-term realist. And being a long-term realist is simply realizing that the long arc of history is one of constant progress made by mankind, but punctuated by moments of chaos and terror. I think one of my favorite examples is that I don't think a lot of us realize, but it took us only 66 years from 1903 to 1969 between the first demonstration of manned flight by the Wright brothers at Kitty Hawk to putting a man on the moon. Can you imagine in 66 years, we first learned how to fly. Then in 66 years time, we actually were able to put a man on the moon. I think that is like phenomenal example of like how of human ingenuity and progress. But in between, from 1939 to 1945, it was World War II, right? And to date, it's still the single most bloody battle that the world has experienced. I think it killed an estimated 66 million people, perhaps even more. But yes, in between there's World War II in between the 66 years between the first demonstration of manned flight to putting a man on the moon. And I think that just by studying history, and you realize that this is how progress works, right? Progress is not a straight line up, but it's a bumpy road that will eventually lead to a much better outcome over a long period of time. And there's this book that I read recently, and I wish that I read it earlier. Is this book called Factfulness by Hans, I think it's Hans Rosling, if I'm pronouncing
Yes.
correctly. Yeah, and it's a fantastic book because it shows how long-term, so we read a lot about the disturbing things that are happening in the world, right? Like there's poverty, there's diseases, there are wars in different parts of the world. But if you look back over, again, a very long arc of history, say over the past 50 or 100 years, there has been tremendous and undeniable progress in terms of all these difficulties that the world has encountered. Poverty has declined significantly around the world. Childhood education rates have increased significantly around the world. Infant mortality rates have declined significantly around the world. And even the number of fatalities from wars have also fallen significantly around the world over that 50 to 100 year period of time. And I think just realizing this, and it's not something that is often reported in the news because it's not newsworthy, right? Because like these things often compound, right? They get better maybe 2 to 3% per year on average. But when you compound that 2 to 3% over a 50-year period, you are able to see a tremendous difference. But this 2 to 3% of compounding in terms of the improvement in human conditions, it's not newsworthy, it's not reported. And so what we see often in news channels are stories that, yes, are painful, but they are not reflective of what I believe is the real underlying long-term trend. So I think just looking at history, I think is just one of the best ways we can to be what I would say a long-term realist. And a long-term realist is really just realizing that humanity has improved over a long period of time, and I don't see any reason why we are not able to continue improving. I mean, when we look at COVID-19 today, Moderna, one of the front runners of the companies that are producing the vaccine, they actually were able to synthesize their vaccine in 2 days, right? And that is amazing. I don't think that there's any vaccine that has been designed in such a short amount of time. And that, again, I think is just another wonderful representation of the progress that mankind has made. Yeah.
Fantastic. So Gautam,
just to summarize what Serging just said right now, and I quote from my book, that people keep fretting over all the problems in the world, but they always tend to underestimate the most bullish long-term phenomena, which is the inherent constant desire in the human race to improve their state of being. So you just need to be an optimist on long-term human progress. That's
fantastic. So we have, I'm conscious of the time, so we have about 3 minutes left. Gautam, if I might ask you, so what's next coming from the desk of Gautam Bed? When are we seeing the next book or the next creation? Very curious to know. Are you working on something?
Well, as of now, there is no plans for a next book, but yes, I'm working on releasing the existing book in different languages. For instance, later this year, we'll be coming out with a local Korean language edition for the Korea market. And we plan to release Chinese language and Japanese language and Spanish language editions too with the course of time. So those are the things which I'm working on. We may also release an audiobook. A lot of people have asked for the audiobook version of the book. So that is also something that we may come out with in the future.
Excellent, excellent. And Gautam, by the way, congratulations. We know that you recently tied the knot, you got married. So that was, that was great news. In fact, many of our viewers here, they are very young, they are single. Our panelists here, they're yet to start a family. So how would you advise all these young people, they're all very interested in investing, but how are you balancing your life? I mean, I would like to know, do you have to cut down on the amount of time you spend with your 10Ks and 10Qs? How do you balance your life between, work and family?
Even before that, let me just quote Munger here, that to get a good spouse, deserve a good spouse. Basically, to get the person you want, deserve the person you want. And I'm very thankful to have got the wife that I did. She's a very special person in my life, and she's very accommodative, and she understands my nature and what the kind of things that I like. So I do love her for that, and I respect her for respecting my personal sentiments and my personal habits. We value investors tend to have a very unique way of living our life, so it's not for everyone. So that way I'm very, very thankful. And as regarding the time to do the daily research and the daily work, that's not really changed that much, because before marriage, my wife knew the kind of person I am and what the kind of things that I like to do. So, in fact, I would say that marriage has been a very good thing in hindsight, because now it is leading to a much more better balance of mixing all the work with a lot of leisurely and pleasurable activities like travel and vacations and spending time together, going out together. So it's actually, I would say a good marriage is all about balance and respecting each other's views and letting each other as they want.
Excellent, excellent. That's so insightful. That brings us to the end of this session, because we have hit our time limit. I would like to extend a very sincere thank you to our guest Gautam Bed and our two panelists. I think the discussions were so insightful. It's going to be very helpful, and my joys of compounding has become a bit dirty from the over handling. I keep referring to it every day. I would very highly recommend this book to all those who haven't read it yet. As I said, I mean, this is like everything, the entire wisdom of value investing distilled into these 400 and some 60, 70 pages. So thank you very much, Gautam, and thanks to you, Kelvin and Serging, for your insights leading the panel discussion. Thank you, everybody. I know it's a Sunday or Saturday evening for you all, but this shows your commitment that you kept yourself away from the other more exciting stuff and decided to spend your time with us. Thank you so much, everybody. And we will be sharing the recording of this session with everybody soon. Thank you.
Thank you, everybody.
Thank you all.
Take care, everyone.
Thanks.
Follow Gautam Bed, author of international best-selling book The Joys of Compounding and Portfolio Manager, at his website at www.thejoysofcompounding.com and on Twitter as well as LinkedIn. Links in the description below. If you have enjoyed this video, please smash the like button below and subscribe to our YouTube channel. Do join us in our investment forum on Facebook, using the link in the description below, where we discuss lots of interesting businesses and investing concepts. Do check out our multi-bagger research series at the link in the description below, where we discuss in detail great businesses to own and compound your wealth for the long term. These great businesses have high growth in revenue, profits and free cash flows. For example, this global payments company has grown at a compounded annual growth rate, or CAGR, of 60 to 80%. While this technology company has grown its revenue at a CAGR of 80%. And this other payments company has grown its revenue and profits at a CAGR of 20+%. Check out our comprehensive options series course on options strategies to complement long-term investing at the link in the description below.